Well, next week's interest rate decision by the Reserve Bank is anything but clear-cut, despite what the markets say. Right now, money markets say there's a 61% chance of a rate cut. You'd reckon that's pretty good. But on Wednesday, the annual inflation rate, it comes out and it's expected by some to move back above the RBA's preferred band of 2 to 3%. And that's normally a signal for higher interest rates, or at least steady, but definitely not lower. Then there's the latest unemployment rate. It was 4.5% in the year to September. That should be a signal for rates to be cut. And there's the dilemma. The Reserve Bank has two key signals: inflation, which says do nothing or raise rates, and unemployment, which says cut rates. So which way does it jump? Independent economist Warren Hogan joins me now. Warren, what's your own sense of that? Which way do they jump?
Good afternoon, Ross. Look, I think their priority is inflation. And this week's number is very important. We've got these monthly numbers that are suggesting we could get a big pickup in the underlying pace of inflation. And that is a worry, because it will confirm that inflation has not only stopped falling, it stopped falling probably around 3%, which is at the top of their target band. But of course, with the economy looking a little better in the last 6 months, it raises this risk that inflation could start rising next year. So, look, the unemployment story is important, but there are reasons for that we could say that the unemployment rate is not the main game for the RBA.
Because the one thing would be is if you cut interest rates now and responded to those employment numbers, which the government would want the Reserve Bank to do, you'd imagine, then what could happen is you fear fueling the inflationary fire. And if that gets out of control, as the Reserve Bank says before, that is even worse for Australians, their cost of living in the future, and indeed their standard of living overall.
Yeah, well, that's right. And look, there's 2 points I think that need to be made here is, first of all, what is driving this rise in unemployment? Because it does not appear to be driven by weakness in the economy or a sudden decline in the demand for workers. If anything, the demand for labour, the demand for workers is very strong and certainly not weakening. So it's probably the result of structural change in the economy, new technology coming in. It reflects the basic underlying reality that the economy of the future needs different skills and workers to the economy of the past and the present. And that's a process we have to work through. But if the RBA cuts rates, it's not going to change that, and it risks making that inflation problem worse. And the other point I'd note is Michelle Bullock has said on a number of occasions that the best way to ensure low unemployment over the medium to long term is to make sure inflation's under control. And if there's any risk that inflation is not under control, when we get these numbers on Wednesday, that's got to be her short-term priority.
And can I be a cynic and suggest that given the government has been responsible for around 60% of all jobs created over the past 4 years or so, that maybe government, state and federal, realising their debt positions, have started to actually stop some of the hiring, and in particular in some of its programs?
Well, that's exactly right. We know that this non-market sector, which is made up of public service plus these industries dominated by government funding in education and health and aged care and so forth, that those were where the big job creation was happening because of the government priorities and the government spending there. That has slowed down and is now growing at a more steady pace, more in line with long-term employment trends in the broader economy. But the good news is private sector employment, which had slowed a lot up until about 6 months ago, looks to be slowly recovering. And of course, that's the employment we want to see, because that's where the high productivity, innovative jobs of the future are coming through. And I think when we get the quarterly employment numbers, we'll show that that process is playing out.
OK, so you don't consider that the Reserve Bank right now has a dilemma, because you can see where the markets are. They say there's a 61% chance that there's a rate cut. They're responding largely to those employment numbers. You're saying just wait, because really once these inflation numbers are seen, if it's rising, then you're going to see a sharp change in that market sentiment, and probably that locks in the Reserve Bank at least sitting on its hands for the time being.
Yeah, that's right. And look, the market expectation is for a 0.8 increase in core inflation, a 1.1% increase in the headline. That number alone will mean the Reserve Bank's forecast for inflation that they gave us in August and will be updated next week has to go up. No two ways about that. that means that, of course, any upside surprise on Wednesday, and I think there's real risk of this because of those monthly numbers, will mean that there's a substantial upward revision to the RBA's inflation forecast. That is their main priority, and that will be of real concern to them. And of course, I think this sets the ground for a very big shift in the policy debate. We know that the markets are being shaped by global factors, the rally in US bonds, etc.
Yes.
This is turning out to be a big week for Australian interest rates.
There's no doubt about that. Independent economist Warren Hogan, always good to chat to you. Many thanks for your time.
Thanks, Ross.